with zero DTE, the thing I love about it is there's so many damn occurrences and there's so many emotional roller coasters, and it's like it shakes you, but it like really gets you good at that skill faster than like anything else.
What the double calendar needs is it needs volatility. The simplest way I like to tell people when I'm explaining it is,
here we are, another episode of the podcast. We're here with Cameron. Little background is Cameron had seen some of my YouTube videos and reached out to me. And then I basically talked to him for like an hour or so on a Google Meet. And I was like, man, this guy knows his stuff. I think he'd be good kind of as like a fellow trader to be out on here. So if you want to kind of give us an introduction of how you found me, what have you been trading, and what kind of are your thoughts around options and investing in general?
Yeah. Well, my name's Cameron. I am originally from New Zealand. My education is I have a master's in mechanical engineering. I moved to America because there's a lot more opportunity. I've actually been very lucky. I've started 4 businesses. I've exited all of them over the last decade. They've all been successful businesses. I seem to have a knack for spinning something up and selling it within about a year. And I've been doing that while, I guess, having a day job here and there, depending on which employer is asking me. And I as time has gone on, I generally speaking, my nature is pretty risk averse. So even though I have an entrepreneurial spirit, I am just like beyond frugal when it comes to the businesses that I've started. I've never put more than $1,000, into a business that I've started, and I've, sold for 6 figures every business that I've been in. So I just, I'm very, very risk averse, and so with that, I've always thought, I need to have cash, and mistakenly. Now I can look back. Now that I'm in my 30s, I can look back, and if I had invested all of my excess cash, along with the additional income from turning these businesses over, I'd already be a multi-millionaire if I had just put that into
So you traded it, or what happened?
So instead, I just, hey, why not, man? Before zero, so I started. So I traded before COVID, as in I bought particular stocks. I bought Tesla, not a lot, but it doesn't really matter because I didn't know trader psychology. I didn't know the standard pitfalls. So I bought Tesla years before COVID. COVID happens, it crashes down to my cost basis, and I go, well, obviously I got to get out because it's going to go to zero. Of course, that Tesla would now be worth a lot more. Other, just tech stocks, a little bit of an index here and there, and so COVID happens, and I become a lot more aware of what stocks are and what the different products are, futures, indices, and then you start learning about why would you do a stock versus something that's like tax advantaged, like the SPX. And the typical answer is going to be something like, well, because you think you have an edge and you will outperform the tax drag that you would be saving. Like that would be the typical pitch. Well, it doesn't quite work that way. I would say from 2020 to now. I'm a lot better now. I'd say so. Probably from 2020 to 2022. I was having plus $60,000 days, minus $60,000 days, and pretty like what ended up happening for me. Is I was pretty much always losing on stock related stuff in the first year, kind of, so between 2020 and 2021. Just classic trader psychology pitfall: holding too long, going options when I should have gone shares, as in like my timing was off. I should have known my timing was off and just gone shares. Like it would have won in the long run, but because I had options, I lost all of the everything that went into there. And so I thought, okay, well, there's got to be a better way. So then I'm like, okay, let's get into SPY, and then I went on to SPX, and I got into doing basically overnight, either single-sided so short call spreads, short put spreads, or both, doing condors. And I got involved in a group of people that for some reason they just really loved rolling. And
yeah, I mean, you never lose. It's the Karen super trader mantra.
so now I really didn't understand what I was getting into, I'll be honest, and that's on me. But it was basically like, hey, we're going to put this on, and if we get tested, because of the probabilities, the chances are that you'll get, if you're beyond the expected move, you'll get tested, and then the stock will revert. The SPX will revert.
Yeah.
And so the whole methodology was don't manage early, only manage late. And so it was basically let it go in the money.
Subscribe to this off of some Discord, or where?
Yeah. I won't name names, but
Yeah.
there is a YouTuber out there whose this was their strategy. A young kid. I meet a lot of trader friends now through that Discord. But he has a YouTube channel. And so the strategy was, when you get tested, roll at the end of the day, so you could be completely in the money, roll that to the next day, or as far out as you can for the amount of debit you're willing to stomach, and you widen as you go. And so you can end up starting with a 10 wide, and then you just keep, once you just get steamrolled, you're in the money, you're now at like a 60 wide, and you're just like, oh yeah, that's like all of the money that's in this account. And now I can't even roll anymore. And the theta I'm paying, which is at that point probably like $1,000 a day, when you're that deep in the money, that short on the to expiry, and you're just praying, for anything to come back. And you're so deep in the money, you can't even safely layer in the other side, right? So like, you're so far. Yeah. So what you end up doing is, you have, the only way to even get a little bit of credit along the way is you actually just you have to add to the side. So like, if you're that deep on the call side, doing puts, there's no way that you can roll out of that will then let you actually get out of the trade, because your put strike is above your in the money call strike, so it's a guaranteed loss, right? And now you're just adding to the loss. So that was really fun. I did that for a year. I'd say those were my biggest losses, absolutely, like without a doubt. Like that's where I lose 60,000 in a day. And the trade account size was like, I've always tried to keep my trade account size around 100 grand, just being like I don't want to lose 100 grand, but I don't want to lose my life savings. So let's have an account with 100 grand. So I'm losing more than half the account in these, and these are realized, right? Even the roll, right? It's a realized loss, and I'm sitting there going, oh yeah, I'm an idiot. Yeah, this is really fun.
Yeah, it actually blows my mind that people trade zeros even remotely like that. Because my big perspective is, I don't really mess with single stocks at all, because I actually think they're quite mispriced, or there's potentially a lot of insider information going on in that. But it's like, the SPX is so ridiculously accurately priced, and in zero DT, there's so many occurrences that the numbers are gonna play out. I guarantee it. You know what I'm saying? And the counterparty to that is just, well, if you size small enough, then it's fine. And that whole martingale strategy, it's like, it is a positive EV strategy, and it makes sense probability wise, but like, how big's your bankroll to do that? And emotionally, can you even do it? You know what I'm saying? It's a very flawed strategy. It's like, I run a very small, no stop, short duration strangle like that, but I'm running it at like 1x notional in my account. So it's like, obviously it's going to outperform the index, but you can pick up 2 or 3% on your account for 2 or 3% buying power use, basically. So that's kind of crazy. But what else do you trade now that you've been enlightened from the light, or how did you apply that to trading differently now?
So I then went down I actually ended up trading full time between 2022 and 2024.
Mhm.
And I guess with the time on my hands, even though options are my thing, and I feel like I now understand them a lot better than I did, I actually go down the whole forex futures side of things
Yeah.
because I got very interested in automation, and I realized, especially with like these prop firms and stuff like that, that there's a lot of leverage out there. Yeah, if you do really well, eventually they're gonna cap you, and they're B booking you. Then they may A book you. They may just tell you to piss off, whatever they end up doing with you. But I really got into building some bots on NinjaTrader and also bots on MetaTrader, and um, that that was my introduction to learning about, to be honest, sequence risk. Like that's the biggest thing that came out of that journey, because while this is happening around in the middle of it in 2023, I find options Omega, right? And I'm like, oh, this is amazing. And I just put in like an old strategy that I did, and I'm like, whoa, $0 to $1 million in 2 months. Like, this is amazing. And what because of the cadence of options, to me, I started to notice really quickly that they hide sequence risk. Like I think I don't, and it's it's very, very deceptive. But
well, what do you think is deceptive about that?
so
High sequence.
so for example, like when you build a bot for futures, especially with a prop firm, you have to be flat at the end of the day, because that's the way those firms operate. And so what that means is that you're trading intraday, and I had 15-second candle strategies, 30-second, 1 minute, 5 minute, sometimes 1 hour. But even then, you'd be stuck in an open trade by the end of the day, and they would no matter what, they would flatten you, and you would just have to live with that consequence. And so when you start building strategies, just in general, right? Okay, yes, these are price action strategies, but when you start building them like that's looking at 15-second data, you're doing 100 trades a day potentially, depending on the bot. And so now, even though you just back tested maybe only a couple months, you're seeing 1,000, you're seeing tens of thousands of trades, and I guess if all markets are like fractal, and all markets will eventually behave like all other markets at some point in time through whatever regime or whatever, you start to see what how success can turn to failure, and so then you get into the options back testing, and you're doing like the common, the double calendar 6-7, the Thursday Friday expiry, and you're really only looking at, like, if you do that since 0 DTE in the back tester, you're only looking at a couple hundred trades, right?
Yeah. And the other thing with that too is, like, when we talk about options, we have to think of market regime as well. So people often like to use volatility as an indicator, which makes sense. But the notional number of VIX, 10, 15, 25, 30, actually means nothing as a barometer, because there's times of high VIX where the mean is 30, like 2020 through 2022. And then there's time of low VIX, like 2016 and 2017, where the mean VIX is like 10. And that's why filtering out any data in general is quite dangerous, especially since when you're using leverage instruments and options, it's like, okay, the probabilities resemble a bell curve. And basically, like, the best way to describe that is, it's a population distribution. So if you drew a circle and you were to drop pins in it, eventually, if you drop enough pins and you measured all of them, you would get very close to 3.14, which is pi.
Mm-hmm.
But, there could clearly be dislocations through the time of it, where it's like, I talk to a lot of people, and in general, most successful option traders are really never short vol. They are always playing long ball, and whatever that is, where it's like, the only way I think you can ever be successful trading options is if you're buying and selling like an incredible amount, and you're always buying more contracts than you sell. Because when those things move, you'd be surprised how irrational stuff could basically spike in the short term or interim. But the other thing is, I know the last time we talked is the whole calendar thing. Like I've traded calendars as a gripe, and you have too. So it's like I'll kind of explain my thesis behind calendars and maybe why I think they're dead, and then kind of other things. So it's like throughout my research of doing calendars, every year that they've been available, and I would try to go back to 2016, so I would test 6/7s as 5/7s, is there's 1 or 2 days of the week that suck because that's just when the big moves occur that year. So it's like one year Mondays will win, Tuesdays will lose, Wednesdays will lose, or whatever that may be. And, I'm a big, I got to start with edge guy. I was always like, Mondays and Fridays make sense because there's a weekend effect. Like the dealers sometime between Friday, beginning of day and end of day, they have to spike the vol to account for the weekend not moving. And then some day before end of day Monday, whether that be open or by the end, they have to basically take it off. And the news cycle is like not that relevant over the weekend. And yeah, when it blows out, and it's terrible, but you're like, how often could that happen? And it's been dragging significantly with August 5th, Yen Vixzilla throwing up over the weekend. Like then we had election holding all the vol and nothing happened. And we had back-to-back like Trump tariff weekends. So I can't really make sense of the calendars now in general, but I know you kind of had a theory of what you thought you saw from them and, what's occurred. So if you want to go through your background on that and kind of what you learned this year with calendars.
Yeah, so if you go back through, when zero DT started, let's just if we're talking this regime, because there's been several regimes within that regime, if you want to call it, right? So
how would you define those regimes?
So if you set up like what we'll call like a classic calendar, and you test all zero DT history, there are moments that stand out as particularly successful and particularly unsuccessful, but for different reasons. And so if you go and you do a back test and you just like you remove all stops except let's say maybe a take profit, but even then, if you just run it raw and you look at 2022 through to like beginning of 23, what you'll see is your unrealized losses are very high, but your win rate is very high. So let's just say you do slap on a take profit.
Yeah.
And the key is what's happening there is that so what the double calendar needs is it needs volatility. Obviously, particularly the differential between let's say if we're talking Thursday, Fridays.
And the other thing with vol too, which I'd be curious to your opinion, is with double calendars, you kind of start to eat the bid-ask spread. So let's say every $10, you could pay $1 to cross the bid-ask spread. So it's like you want an increase in volatility, but if we get a 40% spike in the VIX and your option goes $150 in the money, that difference of the bid-ask spread from being so much in the money to close it out will completely negate any profit you get from an increase in Vega as well.
Totally. So the simplest way I like to tell people when I'm explaining it is first of all, when someone tells you, oh, it's a Vega trade or it's a this or that, no, it's Vega, it's theta, it's delta, and everything's got to go right. And so for example, like when the market is just, let's just say average, what you absolutely do not want is a large move with volatility crush early. So if you open it Friday and you're going for that Thursday, Friday expiration, you come into Monday. If you have a big gap up, which thankfully generally Mondays don't, but they did actually in 21. If you look back in 21, Mondays were like the big, just like, yeah, we're here and we're bullish.
The just fell puts back test. And then another thing with that too is like when we're looking at basically calendarized spreads, it's like we need to understand that we're actually not taking that much risk per se because it's a debit. So it can actually make it harder to make money or harder to theorize around that money. And also we take on a lot of sequence risk because it doesn't happen that much. The losses can be massive and the debits are not necessarily consistent based on volatility or whatever's happening. So you could be significantly taking a lot of risk.
And are you saying? So are you saying if you set at, like, if your strategy is to set at particular deltas, one week your debit might be $4, the next week it might be $13, even though it's the same
and you could
trade?
take the full debit-ish loss on
Yep.
the 13 one, and when you're only collecting 10% profit on your $400 one, it makes a big difference.
Yeah, absolutely for sizing and all that. Interestingly, if you backtest, like, and you go, okay, I only want to take trades that are like up to a 5 debit, or only take trades over a 10 debit. The general, with hindsight, obviously, the general mechanics are like, somehow it's kind of like the market does know roughly what it's doing. Like, that it's more expensive for a reason, because there's a news event or something.
I would also say, like, this is the ultimate crime of the calendar, folks, is like basically everyone I've ever met that does well with calendars leverage the absolute hell out of a small account and is not super consistent with it. And then also when we look at the calendars, is it's like people are like, I want to exit when I'm $40 in the money, and I want to, exit if the volatility does whatever. But since you're holding it overnight, people are like really curve fitting and testing it the wrong way, because when something's going to go boom, like, you don't have mechanics to protect you. So I would just also like to say is, like, you can't test a calendar like 0DT. And it's like your only options of what you can do is you can say, I'm going to use a take profit, and and that's going to be big or small. And basically, like, you could use a stop loss, but that's curve fitting because only 20% of the week or of your trade is during market hours, and the rest of the time it's not going to work. So you're just like, oh, if I come in at 12:30 and I get out at this time, like, it works on Tuesdays because that big move didn't happen overnight on Tuesdays or whatever, or it happened in your favor and you filtered that into your back test that, like, came back into your tent.
Yes, totally. And I actually used to run a stop loss when I started doing calendars, and then I realized the errors of my way. Like, you'd wake up and you'd be liquidated, basically. Your stop would you'd be gone. So then I'm like, okay, let's set some boundary. Oh, if I'm this far in the money, or I'm this far past my strike, or whatever, it's roughly this time. When you trade them a lot, you'll start to see there's like this preferred, like, path of the trade, and the preferred path of the trade is, if we're talking specifically these Friday open 6/7s, is no movement. It doesn't actually really matter too much what volatility does over the weekend, but no movement into Monday, and you want to drift towards one of your tenths, or one of your strikes. But the reality is that most of the time, let's just take like a 20-25 delta, double calendar.
Yeah.
Most of the time, your strikes are so close that intra-week you are absolutely, like, it's not do you have a risk of gapping over your strike? Like, no, you're going to gap over. Like, it's going to happen. So what's going to happen is, if let's say it's a non-news week, because CPI got me a few times.
To preface this too, it's like 25 deltas roughly have a 50% chance of getting touched, and you're doing 2 of them at once. So it's going in the money, I promise you. And
totally,
all the market move happens overnight. Also,
now if that move happens on a Thursday to your strike, boom, you just hit the jackpot. But if it happens on a Monday or a Tuesday, it's not gonna turn out well for you, and you're gonna have to figure out how to manage the trade. So I went into this whole thing. I went into this whole management style of, when it gets near my strike, so I'm not going to have any hard rules, but when it gets near my strike, I'm going to assess, like, is it a Monday? Is it a Tuesday? Is it a Wednesday? Is tomorrow CPI? Do all the discretionary things that screwed me in the past anyway, but now I know what I'm doing. So
when you're running us through this, could you kind of preface it on, like, how much have you gotten return wise, and then, like, are we looking at Friday 6/7s, Mondays, whatever? Like, what's that traditional book look like?
Okay, so my worst losses, I came across the 5/7 4/7 trade. It's a and I'm talking an at the money put calendar, so not a double calendar. And I can tell you from 2022 to exactly February of 24, the back test. Oh, man,
Didn't lose.
It's a didn't lose, multi-billionaire. Start with 10 grand, multi-billionaire, and it was amazing. And that trade got absolutely decimated. And so, in general, what I found with single calendars, because what ends up happening when you do the double calendar, you end up trying single calendars just naturally because they're there. There's something you can do. They do have interesting characteristics. They work really well on the weeks that they work. Like if you end up in a like this, maybe probably what this week might turn out to be, where we kind of just end up sideways. Those single put calendars just print, and they have a really, really high return. But anyway. Then those were my worst losses when those went wrong because you get way less gap protection because you're at the money, right? So all it takes is that first gap and then that run, and you're screwed. You're so out of the money or in the money. The ones that obviously the in the money ones are just hard to get out of, especially if you're large size. Those are all just terrible. So let's just say returns on those were like negative. On a $100,000 account, I think as I tried to work those, I probably lost 20 to 25 grand, like working those over several months, trying to make them work, right? Switching between 4 sevens, 5 sevens, being careful of CPI, blah 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 blah. My best successes were the double 6 sevens at the so last year, September into is probably late August into mid October. So like they started going bad maybe the week or two before the election, right?
Yeah.
And that one. So what I did there, it was just a really, really good string of luck, and I went full. I went full in. I decided I'm going to go small account. I put in 5 grand, and I was doing a 20-ish. 25-ish delta double calendar from Friday open to the 6/7 expiry. Then so that was at a ratio of 2, and then at a ratio of 1, I did a 6/7 put at the money calendar. So it was like a triple calendar, whatever. But I ratioed it, and those weeks, if you like just look at the price, they did perfect at late in the week. They hit one of the sides of the double calendar and they moved through the center. In each of those trades, I put it at a 50% take profit, and I turned that in that period of time, I turned that 5 grand into almost 20 grand. Yeah.
So do you think you got lucky, or that was actual skill?
That was luck, I think. Looking like that, like it was the right time. It was the right place at the right time. I went to Japan on a trip. And I was like, and I'd been dragging my heels over this particular strategy and setting up the bots because this was, I did this automated, and I was just like, what, I'm gonna go to Japan. Let me just click it. I'm just not gonna look. I'm not gonna manage it, which maybe is part of it because I'm an over manager totally. Like that's one of my bad trader psychology or trader characteristics is for sure. I manage when I feel like I've found some kind of edge, I still over manage, right? And that's a big problem.
So now that we're kind of talking edge, it's like, what are you going after now? Are you giving up on the calendars? What do you think is where the edge is at? Or you just said, hey, I'm a tinker, this is my hobby, I don't think I can unlock the edge?
Oh no, I as far as I can tell, I'm going to chase edge till I die. What my P&L will be a different story. So the strategy I've been running right now, that I've got my bots heavily focused on, is it's calendars, but so the thing that concerns me, you've talked about time of entry on like a 0 DT.
Yeah.
That is a particular edge that I find interesting, in the sense that that I can convince myself why on a 0 DTE those certain things are happening. The thing that sucks about testing like calendars and double calendars is you'll find those time periods and they will be amazing. And I'm not just talking like anyone can test a Friday and they can go in and be like, okay, you know, like at close, bad, but maybe at 2 p.m., good, right? Anyone can do that, right?
And I think this is the real fallacy of the calendar yang too, where it's like, I've done tests like this ad nauseum. Like if you're testing 0 DT stuff, like, okay, let's say you trade 1 o'clock put, like same mechanics, dollar, 2x stop loss, whatever it is, and you trade a 2 o'clock put. It's like the 1 o'clock put has got 3 hours left, 2 o'clock put's got 2 hours left. They're 75%. They're like, 75% correlated because it's like, that's exactly what the hours are. Like that's how probable the move is to occur on it. And when everyone starts to get cute with this back testing stuff or whatever it is, it's like, you are eventually going to get bit. It just so happens that the calendar gang and the people that buy AI stocks, it's like the time frame is just longer to like get burnt. You know what I'm saying? Or they take themselves out of one day when they didn't have a good feel about it,
Yeah, absolutely. And so the thing I want to take a note for us to talk about, there are trades where the more people who do them, the more successful they are, barring maybe some market maker stuff.
What's a trade like that?
Okay, let's get there. So and then there's the obvious ones that get worse. So what I want to say specifically before we dive into that is sometimes I communicate what I'm doing with my double calendars and things, and the moment even one person starts trading like your time entry, you can immediately see where your pricing that you're getting from your broker is not just diverging from the back test, but your expectancy is no longer as positive as you had hoped, and it is so sensitive. And so what I've tried to do now, at least with my bots, is I've picked a couple times. Some are on Fridays, some are not. If you want to go in and do a few days worth of back testing, I'm sure you can find some advantageous entry times. But that is to say, I'm keeping those entry times secret. And I've told everyone who I trade double calendars with. I'm not telling you those. I'm testing something. And then I'll tell you if they're successful, and then we can find out if that ruins it. Because I really want to understand how many people can actually trade these specific entries before it kind of blows up. And I think what we're finding, especially with Option Omega and how popular Friday entry became, that you can actually see the spike. Like if you put the spread on and like in your broker, you can see at the common entry times, you can see the bid. It just spreads right, it'd be like right on 2 p.m. and everything will just widen out, and then 5 minutes later it will come right back. 2:15, widen out, come right back. Even in that calendar, right? And I think even the calendar is even more sensitive. Okay, so now to get to what I'm really interested in finding and working on is there are trades that the more people trade them, I think, the more successful they are. They become a self-fulfilling prophecy, and that is going to be somewhere in the realm of gamma. And you can see. Do
you have an example of what a trade like this would look like?
The classic example, unfortunately, of course, are like the meme stocks. If you can build enough gamma,
enough people buy options, it basically takes over the underlying's irrelevant.
Totally.
Yeah. I mean, Nvidia is like that currently, where it's like so many people bought options on Nvidia that people that don't even have big enough accounts to buy options, like BlackRock, made a leverage instrument for Nvidia options, and then there's so much of the S&P that like people buy options, it goes up. S&P buys more Nvidia, its spikes fall down, it pays calls more, dealers have to buy more shares of Nvidia, which pushes it up further, and then it comes basically in reversal, a la 18% move when they announced, when some Chinese company lied that they had some AI.
Yeah. No, totally. So it's, but outside of, so I see these trades, I'm seeing these trades that are incredibly sensitive to a small amount of volume in SPX, right? And we're only talking a week out. And when I say incredibly sensitive, I mean I'm talking in like the 50 to 100 contract range. You can absolutely, like, if you were to tell a friend, hey, go put on 20 contracts, on these specific strikes, and you go and look at them right as he's you can watch it pop. You can just it blows my mind that on a product like SPX that you can actually see that stuff.
I don't think it is, dude. Like in my research, if you're less than 5% of the open interest, no difference between a one lot and that.
So I'm talking specifically calendars. I apologize.
Yeah, maybe calendars.
There's something about this. I don't know if look.
I would arguably say that, like, when you're shopping as a 2-leg order, like, you're starting the price discovery. So like the quote before that, which is a big deal for back testing because Option Omega just says take it whatever. Like, my opinion when I tested calendars is I was like, it's 5 cents a leg entry and exit slippage, because that's like crossing the bid ask. That's just what it is, you know? But yeah, you could really get misstated by that. But it's like the quote on a 2-legged order, it's like people aren't really shopping that because no one's using it to hedging or whatever. Like you're starting the price discovery.
And so I'm not saying I'm being successful in finding these trades, but once you go multi DTE in a single quote, I know it's not actually like a 4-legged. It's not actually a single quote per se, but yeah, just bear with me.
They're pricing vol across durations, so like they have to decide what that is.
Yes, and so when you do that across 2 strikes across 2 expiries, and you go to a specific strike at a specific time, the sensitivity is kind of, it's just mind blowing. Like, generally speaking, the strategies I try and trade, whatever slippage that could be or isn't, it doesn't. I build in a lot of slippage, and I assume everything's going to be terrible. All those things, but I guess what I think I'm seeing is, okay, so the other side of it is you're the market maker. Okay, well, I'm not going to be a market maker probably any time in the immediate future, but just
exchange license 10 million. So it takes a little bit.
Give me a couple 5.7s back in 2023, and we'll be golden. Okay, but I'm becoming very curious into trying to find these trades that and I realize you're coming from the position of like you're pretty much not going to believe it till you see it, and maybe I'm a dreamer, okay, and I'm not saying it's real, but to be able to find a trade where a group of people can trade it and they don't immediately ruin, like on 0 DT, look, liquidity and volume is so high that
it's present in credit trades, because in credit trades the counterparty has dynamic moving stuff. Whereas like when you have fixed strike and you're just pricing vol above duration, it's like, as a retail client, let's say you spend $1,000 and you think you have 3 points of Vega and edge. So that's, $30 basically. Now, if you pay 10 more to get in on the bid ask, you pay some commissions, all of a sudden, like, the retail traders can't trade that because your spread of vol is all eaten up by bid-ask spread and commissions, which, that is basically the phenomenon. But this comes back to, it's like I'm, I still run calendars in my personal accounts to be like, okay, I'm going to run this for 2 years to see what happens. But it's so ridiculously small now. I basically determined it's like calendars aren't worth it because you can lose from vol getting smashed, and you can lose from vol blowing up, and you can lose from vol doing nothing. So like the problem with that from a calendar perspective is you can't manage your risk with offsetting positions. So you can't really build a portfolio. You're basically, like I call it, it's a par 3 contest of trading. You're just trying to like chip it into whatever hole or something that may be. And you can get a little more advantageous if you're doing whatever, each side managed separately and you're taking really small profit takes over a period of time. But I think it's a very fishy type of, edge moving forward, except for maybe the Friday ones,
Mm-hmm. Well, I mean, the way, like, if you really wanted to quant it out, which I haven't gone full quant, but there's going to be, across a period of time, there's going to be moments where price is trendy and price is mean reverting, and so you're gonna have what they call like a trending day, and you're gonna have like a mean reversion day, but you actually have, but trend days can mean revert two trend days can be mean reversion, can also be mean reversion, right? And
there's no single occurrence. Everything's geometric through time.
Yep.
No matter what you look at.
Yep. And so the double calendar, to me, is playing off the fact that there is an idea, the 6-7 double calendar. It's playing off of the idea that there is a weekly mean reversion, but there is a daily trend movement, right?
Yeah.
And so
Fridays, Mondays, Thursdays.
Yep. And so
that's essentially what you're playing.
Yep. And
except if there's news.
Correct. Now
which is priced in.
Yeah, priced in. The news you'll find actually might be the day that gives you the trend day that you needed to mean revert back to your tent post, to your tent pole, your strike. And so if you were really to quant it out, you would quantify the weekly likelihood of mean reversion with the intra-weekly likelihood of trending, right? And you would hope, basically, that you would find an edge, because of course I'm not doing this, right? I'm just like trusting the back test. You would hope that you're finding an edge that the weekly mean reversion happens around Wednesday, Thursday in a Wednesday, Thursday trend. If you can find that specific data point and you can build an edge around it, first of all, a double calendar may not even be the right. Might not even be the right.
We can accomplish this.
Yeah, exactly.
With selling short dated vol that has a massive amount of edge and offsetting it with some type of long vol that prevents the risk. And the other benefit of that is like, okay, if you get gapped, you still kind of get eaten like a double calendar. But a lot of the times, if we get a move, like you have a stop resting in there for some risk protection, you get out at a very reasonable loss amount, and then the long continues to go, which it's like the calendars are an inefficient way for small accounts to try to get a massive return as compared to like really deviating out, because you can make a profit tent with layering long and short options over it, both of which in themselves are quite profitable, whereas a lot of times with double calendars, one side absolutely sucks and you throw it on in the trade anyway, so you're technically trading something that does not have positive value.
Yeah. I mean, a classic example. Well, so I think small accounts is a particular discussion which I feel like I'm becoming more and more knowledgeable on. So I'd like to go there. But a classic example of what you're saying is you can do a 6-7 double calendar that so a lot of things that people are doing right now are like 10% take profits, but which is like insane, because of course like you're essentially risking the debit or some other thing that has a massively wide bid ask. So you really don't even know truly what you're.
Plus the bid ask. Yeah, you're 10-1 trading, but your probability of losing that 10x is actually not that.
Totally, it's the classic stairs up, elevator down, right?
Yeah.
And usually, if you run a 10% take profit, if you enter early on a Friday, sometimes you can enter by the end of Friday, or if you enter on a classic Friday time in the afternoon with that 10%.
I know you had a pattern or something when we talked about it last time. You can kind of go through that pattern of like the Friday, Monday with the profits that marks well. I think we talked about it last time. You remember that?
Yeah. I mean, it might even be part of what I'm saying here, which is that. So let's just there. Sorry. Yeah. Now I'm okay. So if you enter late on a Friday, and let's say you're taking that 10% take profit sometime on a Monday. That's what you're probably hoping for. And to be honest, if you don't get it on a Monday, Tuesday, chances are it's because prices already moved so far away from you and you're screwed. And you can figure out how you're going to manage that. But the point I was trying to make is if you just do a Monday iron condor, which is not even the best Friday to Monday structure. There's way better. There's some ratio structures that you can do from Monday to Friday that are just like amazing, and they're not stairs up elevator down, right? They actually your average win is something in the region of 10 to 20% of your max loss, right? Like it's a these are good trades, right? And they're credit trades, right? And they are more in your classic condor-esque notion, right? And you're just banking on the Monday, vol just gets absolutely annihilated over the weekend. You wake up on Monday and most of the time you can cash out for 50% right there if you want. On most Mondays you can just hold to the end of the day. It's I want to say easy money, not since maybe some tweets have gone out, but otherwise generally it's easy money. And so to your point, when you say like what are good structures for either beginners or small accounts, is double calendar the right structure? I would argue that if you're in the right place at the right time, the double calendars compound better.
Yeah.
But if you're not at the right place at the right time with the right structure, yes, of course,
50% drawdown.
Yes,
can happen real fast.
And well, yeah, I mean, and the thing is when you're trading a small account, let's say you got a $5,000 account. Your average 6-7 double calendar is going to cost you something like $5 or $500, roughly speaking, right? And so your sizing, I mean, are you going to put 50% of your account if you want to catch the dragon by the tail? You're going to want to go 50% of your account. So you're putting on $2,500 right out of the gate. And if you catch the right time, you will have hundreds of thousands of dollars in a couple months. Absolutely. Yeah. That's going to happen. But if you catch the wrong time, that $5,000 is going to be gone in a couple weeks. And once you go below, the smallest debit, now you're just sitting with an account with $400 in it, and you're like, oh, maybe I should try and sell some SPY. $1 wide condors or something, but all of that is to say, like, you can identify these things around the weekend. And I think to your point, what actually is the right structure. And I think it depends on what you want to do. And for most people, most reasonable people who are dealing with the classic trader psychology, the great thing about the weekend is you can't do anything over the weekend, and you put it on at the end of Friday, you wake up on Monday, and you might have to deal with your psychology then, as in you might take profit earlier than you should have, you might stop out earlier than you would have otherwise, but because you are leveraging a positive expectancy Friday to Monday vol crush, generally speaking, even if you're a pretty crap trader, you should be getting enough wins to learn how to be better.
Yeah.
Which I think is, that's really all that matters, I think.
Yeah, it's the iteration of how do you stay alive but keep entertained with your account to a certain extent.
Totally.
And I think that starts, it's like everyone wants to trade single stocks. It's like, dude, single stocks don't work. Like, even like I'm here to say that, where it's like you can get lucky in single stocks, and that's why people love it. And I know there's some very specialized people that trade Tesla or Nvidia and do well, but you can even look at it where it's like the options are what's priced correctly and kind of what the smart people do, I guess, per se. And then the underlying is like the irrational exuberance to a certain extent, even though people gamble on options. And then look at Nvidia, where it's like if you just held Nvidia for the last year and a half, boom, you're rich. And if you're like selling puts in it, you got absolutely blown out. like on the DeepSeek thing and whatever, because like all the volatility is just smashing back, which that's a real good barometer. It's like, okay, if you can trade SPX and make money trading options, and this is assuming you're not looking at like hammer candles or whatever technical analysis people do, and just like making ridiculous position size, it's like it's going to continue to trend in whatever direction you got if it's systematic. And that is really what I would impress like on younger, newer traders, because I know a lot of newer traders want to go after being rich and being some hedge fund manager or whatever. But the real path to wealth is you kind of do this, make 30%, 10% drawdowns without thinking about it much and keep working. It's like it's going to improve your decision making and you're going to get better at what you're doing and it's going to start to compound as well. And that's kind of like what I would recommend a lot of people do instead of, I think calendars are a good place to start. You just have to be careful on sizing, like as being mechanical, to work your psychology. But I guess another question I have is this all stems from what type of risk you're doing. And we can't really like hedge off risk with picking stuff, real risk. And I've kind of recently come to a spot where I intimately understand the risk I'm taking and I'm quite comfortable with it. But the more I've thought about it in advance I've realized that I am taking like a significant amount of risk per se. And I try to offset that to the best degree. But do you kind of think that's where all of the, edge and return comes in life is what is the risk? And do you get to a point where you may be a little naive when you start and then you cross the abyss and you're like, oh, I am taking quite a bit of risk, but I've come to terms that I'm comfortable with what I'm currently doing here, and how does that affect my sizing and what I'm doing?
The problem with the answer is even amongst professional traders, what risk is different. So an example is if you take the guys that win trading competitions, like they're almost exclusively trading single stocks, and they're putting 100% of their account in that stock. And someone might say that's a lot of risk. Even a professional trader might say, "Hey, that's a lot of risk."
They're playing VC investing style,
But that trader who's in that competition, they will tell you, "Well, no, my risk is my stop loss, and my stop loss is really tight." But then another trader will come along and say, "Yeah, and you're holding that stop loss overnight, are you? So what's your real risk?" And what you'll find very quickly is that the best way, and I think it's been said, plenty of times before, but if no one's heard it before, the real risk is determined by your emotional reaction. And the only way that you can understand that is to put on risk. Yes, if you look at the laws of like big numbers and you if you go high risk, but if you go high risk but high win rate, you can do okay. You can do low risk, low win rate, do okay. Like, so as in there's more than one way, to be successful. Paul Tudor Jones' win rate is 30%. He's made a few billion over the years, I think, right? And then you've got traders that I interact with all the time, and they're very successful with 90% win rates. But it's beyond. You have to go beyond the win rate and understand how do you react to the risk you're taking. And if you react poorly, so this is why people first off, when they're teaching people to trade, they argue between paper trading and like real trading, and then they'll say, well, don't paper trade, but trade a couple $100. No. I'm sorry.
Yeah, you have to paper trade and like actually risk money.
The truth is, you will never know ever if you can trade unless you risk an amount of money that keeps you up at night, and that absolutely sucks. Because I've got a lot of friends who work shitty jobs, who they're in their 30s, they're dead end jobs. I would love to go to them and say, hey, just start trading. That is not reality. Most people cannot trade most people are incapable of trading if they tried, as in their accounts will go to zero very quickly. And the best way to find out is to put money on and not be able to sleep. And then you realize what it is to be a trader, and then you can iterate from that as to what risk is to you.
Yeah, and I think the counterparty of that has, at least for me, is systematic, where this always, like, the unforeseen and worst drawdowns are always in front of you. I can promise you that. And like whatever you think your drawdown is, you're going to hit it within 90 days.
I'm a firm believer in that.
Yeah. And the next thing too is if you stake this on something, whereas we talk with single stock people or people getting into it, you're ultimately, I'd say you're lucky, but we'll split the difference. And it's like, you're either lucky or talented. And how a 7 foot tall person plays a game, or someone that bought Bitcoin when pizza was going there. It's like, that's not the formula of wealth. It's like, that's how someone gets rich. And we need to understand like what gets you from basically having no money to like 500 grand is not the same thing that gets you 500 grand to 5 million. And when you like draw the line of what that is in the line of how you're going to go about this. And for me, that's kind of like systematic, where I know this sounds ridiculous, but I like got laid off in 2022 and like took a really shitty job. And I've been trading for my entire income from only having like a 50 grand account up to, over 8 figures per se, where 100% of my income, 100% of my net worth has been in it. And it's like with zero DTE, the thing I love about it is there's so many damn occurrences and there's so many emotional roller coasters, and it's like, it shakes you, but it like really gets you good at that skill faster than like anything else, I'd seen. And you can't really fake the numbers in being automated in zero DT or being back test or quantitative driven, really.
You can get lucky and catch a curve. Yeah. But there is a number of trades that you get to where luck starts to fall away, right? And especially in the systematic game, when if you're putting a zero DTE trade on, it really honestly doesn't matter the size. If you're putting on a zero DTE trade every day, to me, it has to be more than a year because of some of the weird stuff that happens in these markets. So if you do one single zero DTE trade every day for 2 years and you are positive, you are absolutely on the track to doing anything you want there. You have stayed alive. You've figured out where some of your edge is, so you may not have completely capitalized on it, but that's a really long time, right? It's way easier to get onto Reddit and be like, oh, Bed Bath and Beyond, yeah, let me buy this call option that's 99% extrinsic value, and let me see what happens. That's way easier.
Yeah, and you could hit it. And that's a lot.
You could.
And the thing is, it's like the risk appetite of young men at this point. And it's like, there's, I think, a systemic shift. It's like the golden generation. It's like you went to war, you came back, you got a job, like turkey in every pot, house in every whatever, car in every garage. Then it was like baby boomer, like work for the man, like you get a pension, whatever. Then it was like 2000s and 80s, people started to roll the dice. There started to be a little wealth inequality. And I think that, this millennial Zoomer Gen X generation or whatever, it's like, it's come to a point where it's like, who's been rewarded? It's like the people that work for a stock or tech company that rips and they can exit at 20 or 30 or whatever. It's people that bought Bitcoin. It's people that bought call options on Tesla. And it's like, that's going to get shaken out. It did in 2022. I think people already kind of forget about that rise from 2021 to 2022. And it's ripping back up again. And I'm really curious to see kind of how this unfolds. May not be this year, maybe next year, it's macro stuff. But even this year, I think that the market's going to exhibit bond-like returns. You know what I'm saying? Like 5-6%, type thing. But we could rip somewhere that's insane. And these mega caps are, really priced for perfection, and AI is cool and all, but who knows how that works out.
Yeah, generally speaking, consensus is wrong. And I will say, consensus is that this year will be approximately flat. Like that's like all the talking heads are like, oh yeah, we had such a good year in 2024.
If you
It's
talk to
gonna.
tech people raising money, no, we're in a
Okay, yeah, but they're paid to
yeah,
lie. They're paid to lie. Okay, that's a different thing.
yeah,
Like general talking heads, they're like, yeah, it was such a great year. Like, yeah, we think, it's not going to be a bad year, but it's probably not going to be a great year. It's going to be somewhere in the middle. I think that's at least my read on current consensus, which means it's either going to, we are going to have another 2024, and it's going to just keep going up, or there's going to be something scary lurking in there, and there's a lot of stuff happening at the Treasury. And the guy, I think his name is Scott Bessent, he believes in the fourth turning, and he believes that we're living in the fourth turning right now.
I'm a big buyer of that.
Yeah, and now I don't mind people agreeing with the fourth turning. What's a little bit scary is that he in particular has said that he wants to oversee the fourth turning. And I'm a little worried that might be a little, especially when it comes to issuance. Oh yeah, if you want to oversee the fourth turning and you want to change issuance at the Treasury, you can oversee the fourth turning. Yeah. That could be a self-fulfilling prophecy. So I don't know. Yeah, there's a lot of stuff going on. I love sentiment. I love the news. I love I love the disconnect that it's always price first, but everyone tells the sentiment story first. But if you actually watch price every day, price is always first, and then the story of why it moved comes second. Yep. Right? And I love that game. I love seeing who says what, and then over the next few hours, everyone starts saying the same story. Right? It just becomes locked in. It was a Trump.
90% of the time, it's some like hungover guy on Wall Street.
Totally.
That accidentally moved some oil ETF with like $1 billion of a fat finger, and then CNN is like, the Sheik talked to Trump today. You know what I'm saying? Like, dude, it's like some hungover guy did that.
No, and it's just like I guess maybe as a human, I love that stuff. But what I really love about what you do is you can be in. It's like you can be in the fishbowl, but you don't have to be in the, like you, Mark, you can be in the fishbowl, but you don't have to be in the water kind of thing. And like, I think that's what, so, it's like you get to enjoy the market in all of its craziness. But at the end of the day, or, the end of the week or the end of the month, you can look at your positive expectancy. You can look at your Netflix, ticking up to new highs.
I don't need to read tweets from Sam Altman how close they are to Gen AI.
No, but you can, and you can do it for fun, and you could laugh and think, oh yeah, Nvidia just gapped down 10% because some Chinese company said they solved AI.
No, I mean, a lot of people gripe on me. It's like, maybe I'm the idiot. Who knows? But the behavioral edge I'm cashing in on is numbers play out, and I'm smashing the probability button as much as I can.
Yeah. Something I wanted to mention earlier, that I think so retail, there are things that professional traders identify, and they usually come with time. And then there are things that retail or people who want to get into trading and they look at. And I know that's the obvious, but the reason why retail gets into buying way out of the money call options on a particular stock, it's because all they see is the final win outcome, right?
Yeah.
But what they don't realize is with time, volatility is your biggest enemy. So if your intention is to compound, you do not want to compound an account that has high volatility in its P&L.
Yeah.
Because you'll get volatility drag, right?
It's like you look at Bitcoin, I forget what it was. It was a crazy event though when SPF and went under, but I'm pretty sure in 2022 it was at $16,000, which was the same. It was at a peak in 2017. And it's it's always doubled and it's always minus by 80%. And it's for the vast majority of the time you own Bitcoin, you have no idea if you're making money, and your P&L is probably not very positive. You know what I'm saying? People just keep holding it, where it's if you limit that volatility drag, you're getting rid of the bad luck too, and I don't think people understand this. You're accepting the bad luck and the good luck, or that extremely outsized returns and the extreme downsized returns when you play a game like that. And that's why I tell people, it's like, you want to do that, 10% of your account, go for it. You know what I'm saying? But outside of that, it's like you're just playing stock market. And, I'm from San Francisco, and I see it a lot where a lot of people play stock market with their careers by going to some startup. They throw in all their assets and money and the high flying stuff. And it's like, that's how they play. And again, it's been rewarded a lot, 15% compounded returns since 2008 in the index. You know what I'm saying? So you can play it, but mathematically, you're rolling the dice.
Yeah, and that's why when I started my kind of introduction, the hesitancy to buy and hold is in my nature, right? Like there's even though it's the most successful trading strategy known to provided that you're buying an index, right? I'm not talking about buying.
I love the index, dude. Yeah. It's like if Bitcoin goes to $1 million, you know who's going to own a lot of it? The S&P 500.
Yeah, totally. No, you're right. Yeah. You're absolutely right. And so anyway, like that idea that it's always worked in the past. There's something in me and maybe in other people where it's like, oh yeah, but what about tomorrow? And you have to, if you're gonna dip your toes even a little bit in anything active. Okay, so one thing is to go crazy and start trading 0 DTE, options. But most reasonable people, they're gonna buy some stocks here and there. They're gonna think, oh yeah, I heard about Palantir on the news. Like, I'm gonna buy it at when it's literally a vertical line because I heard about it, right? And over time, they're going to get burned and they're going to be like, oh, okay, well, I'll buy the index. And then they'll be like, oh, but I heard it on the news. And then they'll sell the index and they will lose. They'll lose their retirement. In a handful of trades, an average person can lose their entire retirement very easily. And when I say lose their entire retirement, I mean, you have cut down your ability to compound so greatly that you have lost your retirement. And interrupting that compounding machine is actually the biggest risk for most people. And so it's not even like, oh, take a little bit of your portfolio and do this other thing. No. Don't touch your retirement. Don't touch anything. Start a new account that you fund every week with a couple $100. Get it to something reasonable, like for SPX 0 DTE would be something like $5 to $10 grand, to do some tighter wing spreads, and then use that. Stop the moment you start touching your current allocation. For most Americans who are already heavily invested in the index, that is how you're going to lose all your money. That's how you're going to lose your retirement in a very quick amount of time. In a year, you can easily lose everything you've got because you thought you knew that buying, Tesla or Palantir at the top was like the best thing you could have done.
All right, you got any other questions or anything else burning on your mind you want to chat about?
Man, I could talk forever. Yeah. There are some things I was going to talk to you about, but I think they're probably better.
Go ahead, dude. We can do another 10 minutes if you have any questions.
No, I was just going to say they might be better. They might be better to not give away. I was going to give you some secret source stuff I had written down. But no. It's been good, man. I really appreciate the chat. You have convinced me to dabble less with my double calendars. Because I do agree with you, and I am.
I took a crack at them. I applied the same knowledge that I have that's worked with other stuff, and the two things I came up with is we either don't have enough data to make good decisions on it because of the whole weekly circumstantial thing. People are just lucky and curve fitting, like we talked about the times, missing out on moves from a small data set. But what I really think it is you're just not taking enough risk. There's more efficient ways to layer off of that risk,
Yeah, I mean it's
trading in at the money 5 wide, technically isn't that risky than trading like a 200 wide dollar option that's out of the money or something. It's just there's not enough hedge in it. You're giving it all up to crossing the bid-ask spread, and where's the theta? You need the theta to behave in a special way, not how it's priced to behave.
Yeah. No, I mean you make a good point actually about that having not enough risk is too risky. I don't think that's a concept that most people are going to understand. But maybe to say it another way is, you got to spend money to make money. Like if people understand that, that's really what you're saying, Mark. And in the mechanics of the trade, every trade that you've ever thought of, someone else has thought of. And as you're placing the order in your broker, the market maker is already getting a heads up notice that you're about to place this trade. The market maker is not your enemy. The only reason you can trade is because of the market maker. Yeah. But the market maker is looking at an arbitrage of a statistical model.
And they want to transact.
Yeah, and they're only going to give you the trade if it is in their benefit per their statistical model. And that's when you get filled and when you don't get filled. And when it comes to these double calendars, I just say what you're saying a different way maybe, is that they are, there's not, it's far too easy because of the actual low amount of risk in the grand scheme of things. It's far too easy to have whatever edge that you could have as a retail trader be squeezed out by the market maker. Again, they're not your enemy. They're doing their job.
You have 3 points of fall, and they're just like, okay, we'll offer it to you. That's your ball.
Yeah. And I was hitting, it really bothers me when I see like all these comments about like the evil market maker and stuff. It's like you have no understanding of how the market
makers
works.
Take risk as a counterparty as well. That's why they can offer such ridiculous prices sometimes to you. Like look at 2022. The market makers did not want to hold those options. They were paying people a lot of money to do it.
That's right. That's right.
It's like whoever. It's like I don't know that much, but it's like that market maker probably owned a bunch of commercial paper and they were underwater like billions of dollars on interest rates, and they're like, we're not going long these options. We need someone else to take them off our hands.
Totally.
Yeah.
Okay. Well, it's been fun.
Well, pleasure.